The idea is preferred returns must be satisfied first, then the cash flow. But now the question is, can the deal accommodate both? Especially in year one, it's difficult for the deal to accommodate both. But there's a deal we did. We closed on it in 2023. For the first 1 year plus, we did preferred returns completely and we shared cash flow to the investors afterwards. This is a deal of 80-20 split. That is, the limited partners are going to go with 80% and the general partners 20%, with an 8% preferred and a catch-up. This is a second way of structuring a deal. So the first way I said was just straight up, we make profit, we distribute it as 70-30 split, 80-20 split. That is straight up cash on cash for everyone. Simple. This is another way you can also structure a deal. This one incentivizes both parties, the limited partner and the GP partner. So for example, this deal I called Reggie, this deal is 80-20 split. You will take 80 because you are bringing the money. I'm taking 20 and I'm going to give you 8%. But the moment I give you 8%, Reggie, you hold on before we share profit. I have to take my own. I have to catch up. And after we catch up, whatever is left to split. So in this example, I have here as we made a profit of $200,000. The LP invested 1 million. We promised them 8% and preferred returns on 100 million, which is 80,000 per year. So step one, first 80% goes to LP. So once we make 80,000, we'll give it to the LP. LPs, this is your 8%. What next happens is called catch up. So we'll catch up with 20% because it's an 80-20 split. You've taken 80%. So I'm going to catch up with my 20% as my own pref, right? So I will take my 20,000. So whatever is left is called a promote. That means you move to the next level. Promote means GP split, the common equity 70-30. So whatever is left, in this case, it's an 80-20 split. We now split it as profit. So in this case, I've satisfied the LP $80,000 as their preferred returns, and I've satisfied the GP. We've taken our own $20,000 as our catch-up. Then now we have a split. Remember, we now split it. The remaining money that is left after we shared it is 100,000. Remember, this is 200,000 profit. 80 went to the LP, 20 went to the GPs. The remaining profit, we now finally split it to 80-20. Overall, the LP is taking 160,000 and the GP is taking 40,000. So the final split is 80-20. So this is the second way you can structure a deal for an investment.
So in this scenario that you just shared with us now, so if an investor invests 50,000 for simple math, $100,000. So it looks to me that at the end of the day, each year they're going to get more than the preferred return of 8%, right? Like if they get the preferred return and they also get the cash on cash after the preferred return, so eventually they're going to get more. I mean, for a deal that is doing well, you would expect the LP to get more than the preferred return.
Of course. The idea is preferred returns must be satisfied first, then the cash flow. But now the question is, can the deal accommodate both?
Oh, okay.
Especially in year one, it's difficult for the deal to accommodate both. But there's a deal we did. We closed on it in 2023. For the first 1 year plus, we did preferred returns completely and we shared cash flow to the investors afterwards. So it just depends on how good the deal is, how much cash flow the deal is providing and all that. So I forgot to mention this, and let me put it into the right perspective. For so many of us, like I said, I started with saying that you invested 50,000 but you want $1 million for the deal you invested $50 for. There's nothing wrong with it. But if you see that deal, please let us know, because I would like to be in that deal that you invest 50,000 and get 1 million. I would like to be part of that. But truth be told, the idea of preferred returns and cash on cash is like you putting the money in the bank. You know, when you put money in the bank, two things are happening. In your mind, you feel the money is working for you because maybe you're receiving 1% from the bank, from the lender. You might feel that way. At least every year I'm getting 1% or whatever that is with your bank. Different banks, different percentage. But I think the average is 1%. So because you are putting your money in the bank, they are giving you interest on your funds. It's the same thing. Because you've invested 50,000, 100,000, 200,000 to a deal, you are collecting some form of interest on it. But the difference is, if you look at the bank, is 1%. But if you look at multifamily, it's 7%. You cannot beat that. Or it's 10%, or it's 8%. You can't beat that. So that's the difference. Rather than you putting your money in the bank and looking for 1%, it's better you put it in a deal. The same way, the same mindset you have that my money is working for me. money, putting it in the bank. Have that same mindset that your money is working for you, putting it in an asset. While the asset is performing, you are getting interest on it. Literally, that's what it is. That is why it looks like peanuts. The idea of preferred returns and cash on cash is not the chunk of money. That's not the idea. Let's go back to the bank narrative. You put money in the bank. What they do with your money is that they take those money and invest in the stock market. That's the truth about it. When they make profits on it, they don't share it with you. No, that is it. But for real estate, the difference between that is you put your money in real estate. They give you preferred returns and interest or cash on it. When they refinance or they sell, you share the profit alongside with whoever is managing the deal. That is the difference. And that's what you will not see if you put your money in the bank. So now the question is cash really king? What I'm trying to say is that putting your money in the bank might not just be the right thing for you to do, looking at the advantages of investing your money and getting interest on it, because that's what it is. You're getting interest. You're being paid. I don't want to call it cash on cash or preferred return. See it as interest. That is why it is that amount, 7%, 8%, 10%. The real amount comes from the sale. That is when you get large chunk of money. So you've invested 100,000. It's at that point you can get 80,000 or even 100,000 from the sales or even 50,000 from the sales. It's at the point of sale, refinance, or any capital event. It can be supplemental loan at the point whereby you are either removing funds, removing cash from the deal, or putting cash from the deal. That is where the large chunk of money comes in. So when you are getting distribution and you're getting $500 or $700, the first thing for you to note is it says 7%. Does it meet the 7% or is it actually 2% or 1%? That's the question you should ask. Once it's 7%, let's say they actually gave you the 7% and the 7% looks like $1,000. Don't get upset and say this cannot get me to my financial freedom. Where the financial freedom is at the point of sale or refinancing or the tax benefit. The tax benefit is massive that most of us do not understand how that plays out.
First of all, thank you for letting me.
No
So,
problem.
guys, all I'm doing is throwing something out there for you to think about, and that is we used to do preferred returns, and I used to watch a lot of people do preferred returns, and as you know, many people back in 21, 22 that bought, they did preferred returns. And so where I'm going with this is a little bit deeper. Yes, a preferred return gives the investor the first return out of the deal. Totally agree with that. But what I want you to think about the potential for a GP to now have a property that is struggling because interest rates went so high. And now we have a situation where the GP needs to really put a lot of time and attention on that deal to save it because it's really struggling because of the rate changes, maybe a business plan execution problem. But now as they continue to not be able to pay that pref and it accumulates year after year after year, at some point it has the potential to impact the behavior of the GP and the GP team because they need to spend a lot of time and energy on that, but they do it knowing full well that they will get nothing out of it. Now, that doesn't mean that a GP should change their behavior because they should always protect their LPs. But I'm just bringing human nature into the equation here because if instead you knew that we dropped the preferred return because if we share with our investors at every opportunity to get cash, then now I know there's a better opportunity for the GP to make money. Mm-hmm. So now they're going to put their time and attention because most GPs don't just do one deal. They do multiple deals. And so now all the deals that you're doing now in 24 and 25 with high cap rates, you want to put your time and attention on those. And you really don't want to spend your time on those deals that you know you're just going to do your best. So I just wanted to throw that out there for you to think about the effect that it might have on the behavior of a GP. So that's how it could potentially hurt an LP because some GPs, I'm not saying we would do that, but some GPs will just give up. They'll say, it doesn't matter what I do. I'm not going to get another dime out of this. Sorry, guys. I'm going to turn in the keys. And whereas they maybe would have been willing to fight it out if they had a better chance. I'm not saying it's right. I'm just giving you that possibility.
Exactly. Thank you for coming, and your presence is highly, really appreciated. For those of you that don't know, Kenji is one of the top multifamily experts in the industry. No,
you are.
Give me your flowers.
That's not why I came. I came because I love what you guys are doing, and I haven't seen you in a while.
Oh yeah, so let's give you the flowers. And the reason why we are doing this is some of our investors gave us a feedback because we structure our deals either to have preferred returns, and some of them we don't have that on it. But we noticed that when we give them, let's say $1,000 per quarter, some of them are like, what will I use $1,000 to do? Will that make me rich? So myself and Ify spoke and said, no, know, I think there's a miscommunication, misconception, state it clear, and for them to understand how this can benefit them and benefit us and where the chunk of money is. And before you came, that was exactly what we discussed, that it's not really an incentive for the GPs, really, truth be told. It can make GPs say, I've been struggling, I've been putting my time, my effort, even my money on this deal, and I'm not taking any money. Rather, the investors are taking it. I will sell. I'm going right ahead and
But
selling.
is that the right thing for the investors?
No, that's
See, it
not.
could hurt the
That's not
investors,
good.
is my point.
We saw that happen last year, last 2 years. A lot of deals.
Oh, it's still happening. Yes.
We saw that really happening and all that.
And so the other thing I would say is, if you think about it, you have an 8% preferred. That's pretty healthy. I mean, that's really high. I mean, good for you. You're able to do deals to pay
No, we
that.
do 7. No, truth be told, this is sample.
Most people are doing
We do
6.
7.
So at 7,
No, we do 7.
you're still killing
Yeah.
it. Good job.
Yeah, thank you.
If you just want to know, though, so the preferred return really doesn't mean anything. If on a 6% preferred return, if the whole deal does 7.5%, the preferred return means nothing, right? As long as the whole deal is 7.5% because of your catch-up.
That's it.
So that's another thing to just consider. As long as if the deal's tanking, if the whole deal makes 7.5%, are you proud? You consider it a failure, right? It's a failure. It's a failure. So in most cases, the pref doesn't really matter. It just makes investors feel good. I will tell you, though, that the trend is more toward getting rid of the preferred return because for all the reasons that I described.
But Ken, to that point, doesn't this make a good case for GPs to therefore throw in their own equity so that they are also?
So they absolutely should put their own equity in.
That's what we do.
Right. So apart
Yeah, I
from
was going to say, you
having
have
skin in the
GPs that don't put any money in the deal. I would never
Oh,
give
no.
them money.
No.
Right. So I mean, apart from being able to say I have skin in the game, they are also getting distributions purposely with the LPs. So
Absolutely.
if that is happening, should their demeanor really be affected and impacted if they're
Well,
not?
and it's only, look, I'm not saying it will happen. I'm saying it has the potential. Because if you have 5 deals, you're a GP, right? And the most recent 2 deals, they're 80-20 on $1. So every dollar you distribute, you get 20 cents, they get 80 cents, right? And then you have these other 3 deals that are struggling because you did them 3 or 4 years ago, and you know that there's not a lot of opportunity for you to ever really make any money. I mean, you got to do the right thing by your investors, but I'm just telling you, human nature, you're going to start paying more attention to the deal you can make money on, just like investors. Investors love to graph the returns when they're making money. They don't open the envelope when they're not making money.
Yeah.
These kind of do the same thing. I'm just telling you, I watch a lot of them do it. I didn't say it's right. I'm just telling you, these are human beings, and you got to think, you want your GP to want to spend time on your deal because that's your best option. That's the best scenario for you. And last comment on the preferred return. We all know this cash flow is not why you're doing this. People get very confused about this. Yes, the cash flow is nice, of course, but you're doing this for the appreciation. That's where the money is. Massive, massive money. For every dollar of new income you can create, you should be able to generate value between $17 and $20. Like, that's massive. I would defer all my distributions. Keep the money, put it back in, and raise rents. You can't do that with investors because they don't want that. That's not what they want. They want some cash flow.
All cash flow.
Yeah, they want cash flow. So you give the
Yes.
market what the market wants, right? But the reality of it is we get rich in real estate because of
Like for us, we always roll over our acquisition fee. So we don't take acquisition fee, we roll it over to give us more, more.
Oh, sure. You put it as an investment. Absolutely.
That's what we do. Yeah. So thank you so much, Ken. Please
Sure.
don't go. We still want you here, please.
Okay.
We're happy to see you here, so please just stay.
Well, thank you. It's your show, though. I didn't want to take it over. I just wanted to
we're happy
pose
you're
that
here.
opportunity.
It just shows we're doing something right, So the first one, like I said, you can easily structure your deal to just be cash flow, normal straight up cash flow. That is, paid your lender. The remaining money is cash flow. You distribute it as cash on cash. The second one was the one I just told you about, which is you issue preferred returns, maybe between 7 to 10%. Then you do a catch up as a GP, and after that you do a promote. Promote means at that point you now do the splits. If it's 70-30 split you agreed on, or 80-20 split that you agreed on, that is what you get to do.